Is Logitech a buy or a sell? Let's get started with the model. This is a large cap company, 12 billion market cap. They're trading at $82 a share, and they have 151 million shares outstanding. Logitech develops and markets personal peripherals for computers. This includes keyboards, mice, tablet accessories, headphones, headsets, webcams, Bluetooth speakers, universal remotes, and much, much more. They were incorporated in 1981, headquartered in Switzerland. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Look how much their free cash flow grew from 200 million to 440 million to 1.1 billion. It did come down a little in the trailing 12 months to a little under 1 billion. Really nice margins. They convert 22% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's pretty much flat from 650 million to 700 million. It did dip a little in 2023, but came right back up. Revenue is a sales for the company, and that doesn't look so good. It drops from 5.5 billion to 4.5 billion. They really need to pick it back up. With rampant inflation, revenue should be going up a lot. They do pay a dividend of 1.65%, which they can cover 5 times with their free cash flow. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows, past year 4, that's 22 billion. We discounted those numbers back to today's new weighted average cost of capital. We get a value of the company of $20 billion. We divide that by 151 million shares. And we get a calculated stock price of 132. They're trading at 82, so they're trading at a 38% discount. It's a buy according to the model. Do you think it's a buy or a sell? Let me know in the comments. There are 33 companies in the same industry as Logitech, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend that much on CapEx, which is a surprise, only 50 million, because they manufacture a lot of products. So you would expect their CapEx to be a lot higher. They don't have any debt, debt-free. They pay a nice dividend of 1.7%, equal to the median. Only one of 5 companies to pay a dividend in this industry. They generate a lot of free cash flow, 1 billion, more than the 4 companies above it. Look at Supermicro. They generate no free cash flow. Their market cap is 9th on the list, 12 billion. They're trading at 6 times book value, 18 times earnings, which is better than the median, 13 times free cash flow, a lot better than the median. They're trading better than 3 times revenue, and they generate 4.5 billion of revenue, a little less than the average. And their 5-year annual revenue growth rate is 9%. I'm surprised it's that high, because when we saw earlier, their revenue was coming down. And they are trading pretty close to their 52-week low, so it could be a good time to pick up the stock. If you put $10,000 into this company 10 years ago and reinvested the dividends, you'd be pretty happy at $72,000 today at 22% annual return. To summarize, I have them trading at a 38% discount, ranking 6 out of 10. I think it's a good short-term buy, 8 out of 10. It's trading pretty close to its 52-week low. I think it's okay long-term. I'm not so confident as a long-term investment due to all the competition. They do have really good ratio, 7 out of 10. Financials, 4 out of 10, because their revenue is going down, and your revenue should never go down. Let's take a look at their income statement. Here's a third quarter of 23, third quarter of 24. Revenue up a little bit from 1.06 billion to 1.112 billion. Let's see if they give a breakdown of the revenue. Of the 1.1 billion of revenue, 480 million is in the Americas, 350 million EMEA, 284 million APAC. APAC is almost flat from last year. EMEA is up the most, it's up 40 million. Americas is only up 18 million, and it was much larger to start. So as a percent, EMEA is up the most. 10% of their revenue is to China, 10% to Germany, and 10% to the US. Here's a breakdown of the revenue by product. Gaming revenue is still leading the way, 300 million, that's up 7%. Keyboards and combos, 209 million, up 8%. Pointing devices, about 200 million, that's up only 2%. Video collaboration, 160 million, up 5%. Webcams is down 9%, it's 80 million. It was 88 million. Tablet accessories, 86 million, that's up the most, 34%. Headsets, 47 million, and other, 37 million. Other is mainly speakers, as they mention it down here. So their total revenue is up 6%. Let's go back to the income statement. Below revenue is cost of goods sold. These are all the expenses directly tied to generating the revenue, $627 million. So their gross profit, $486 million. Last year, $434 million. So their margins improved a lot from last year. Last year, their gross profit margin, 41.5%. Now it's 43.6%. Let's look at their operating expenses. Marketing and selling, $200 million. R&D, $76 million. G&A, $44 million. So total operating expenses, $325 million. Last year, $282 million. So their operating income is only up a little bit. It's $161 million. Last year, $157 million. They receive $15 million of interest on their investments. Their pre-tax income, $176 million. Taxes, $31 million. So net income, $145 million. That's up from $137 million. And they're decreasing their shares. Last year, they had 158 million shares. Now they have 152 million. Earnings per share is net income over shares outstanding, which is up to 95 cents. Last year, 87 cents. Let's look at the balance sheet. Current assets, $2.7 billion. Current liabilities, $1.2 billion. So they have a current ratio above a 2. They have $1.4 billion of cash, $600 million of accounts receivables. This is how much money other companies owe them when they sell on credit. A little over $500 million of inventory. Here's a breakdown of the inventory. 55 million raw materials, 460 million finished products. Let's look at the non-current assets. 112 million of PP&E, property, plant, and equipment. They have a lot of goodwill, 464 million, which implies they do lots of acquisitions. Their total assets, 3.6 billion, a little higher than last year. Liabilities, 1.5 billion. They have 555 million of accounts payables. This is how much money they owe when they buy on credit. Accrued expenses, 646 million. This means they incurred an expense but haven't paid it yet. Income taxes payable, 126 million. These are taxes they're going to pay in the future. It's in the non-current section, so they're going to pay it beyond 12 months. Assets minus the liabilities equals equity, 2.1 billion of equity. They raised 100 million from selling stock, 30 million plus 72 million. They bought back a lot of stock, 1.5 billion worth. Treasury stock is a contra equity count. It brings down your equity balance. That's why it's negative. And they're really profitable. Their retained earnings, 3.6 billion. Retained earnings is sum of all their prior net incomes minus the sum of the dividends they paid out. Let's look at a statement of cash flows, the trailing 6 months. Their operating cash flow is 340 million. Last year was higher, 460 million. It looks like inventory was a big reason. Last year they had a cash inflow of 146 million on inventory. This year they have a cash outflow of 94 million. That's about a $240 million swing. They spent 29 million on PP&E, last year 35 million. They didn't spend any cash on acquisitions. Last year 14 million of cash. In their financing section, they spent 208 million on dividends. They bought back 260 million of their own stock and some other smaller things. Let's take a look at a company on Simply Wall Street. Its last price, 82, 12 billion market cap, down 3% in the past week, down 12% in the past year. They started trading a long time ago, back in 97, at $2.28 a share. This is stock split adjusted. It looks like by the end of 98, they reached their all-time low. So the stock went up 34x. From a little over $1 to $34. That was in 2007. It did fall to below $10 at a couple points. In 2009, it was as low as $7.64. In 2013, it was in the low 7s. But you just have to buy and hold and just wait it out because good stocks come back up. So from 2007, it was 33. A decade later, it was still 33. But COVID gave it a huge boost. It went from 37 right before COVID to its peak at 133. It never got that high again. It did fall to the low 40s in October 2022. So that would have been a great time to get the stock because it hit 100 again in mid-2024. Now it's come down a little bit, trading in the 80s. Simply Wall Street's value is 68. They say the stock is 20% overvalued. 11 analysts priced this stock at 90. They say it's undervalued. Here's their dividend since 2014. It was a little under 2%. In 2015, it was its highest ever, 3.8%. But it's come down to as low as 1%. Currently, it's around 1.5%. The forecast is 1.8% by 2027. The CEO's salary is $422,000. Total compensation $7 million. His tenure as CEO is less than 1 year. There's no insider selling, but a couple of insider buys in the past year. 62% of the company is owned by institutions and 37% by the general public. Their biggest shareholder is BlackRock at 7.5%. Arrow Street Capital, 1.5%. Deutsche, 1.25%. And you'll see some European companies on this list. Their employee count was 6,300 in 2014. Its highest was 9,000 in 2021. Now it's 7,300. The ticker trades on the Swiss Exchange, NASDAQ, London Stock Exchange, BATS Europe, and Mexican Bolsa. So if you want to get a copy of a discounted cash flow model, just click on the video in the top right corner. Thanks for watching.